All right. Tonight we're going to discuss mutual funds and we're going to clean up some other things. Um, there's a bit of homework. Um, we're getting sort of towards the end of the course, so the homework will start to lessen here a little bit so that you can spend more time on your project. What we're going to talk about is mutual funds, but I think probably the best way to do it though is let me discuss the homework so I don't kind of give that short shrift. And we'll talk about the podcast, the homework, and the term paper. So this is going to be homework for this week. This is actually a pretty good exercise because people will, if you talk to people in real life, and people will have certain opinions on things, and they'll think they're absolutes, and it's there's a lot of things that especially in personal finance, are not necessarily absolutes, and there's different perspectives, different ways to look at things. Like, I've said things about bonds, for example, that would probably, might make you think that they're absolutely the worst investment in the world. Well, it depends on the timing. Right now with low interest rates, yeah, they might be. And then the same thing with insurance. There were a couple people who, you know, for one reason or another, like some of the other insurance products, which is just fine because that's why there's a market and that's why things are available. But one thing here, this first question has to do with tax-free investing, and sometimes people will say, "Oh no, I absolutely want the tax-free." Well, the 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 thing with any investing and the yields paid on any investment, the reason why you get, in this case, 7.9% or 10.2% is because that's what it takes to get investors. They're basically selling a product, and to get you to buy the product, to get you to make that investment, they have to offer a interest that interest rate that's going to entice you to invest. And the reason why they have to pay 10.2% is because, well, they have to. That's what they've determined is, sort of the tipping point in this case. And the interest rate that's paid on investment should be directly correlated to the amount of risk you're exposed to. So a few years ago, there's a Bernie Madoff guy, just not a nice guy, but these people are getting 20 some percent year after year for these risk-free investments. Well, guess what? That doesn't make any sense, and it didn't make any sense what the guy was doing. It was a pyramid scheme. He was getting the new investors, taking their money, giving it to the old investors, and he really wasn't making any money from investments at all. He was just doing a pyramid, a Ponzi scheme, and anyway, it all fell apart. But when those people, acted like they were ripped off and defrauded, well, they knew they were getting 20 some percent interest. They never looked a little bit deeper. And so, you have to do a bit of due diligence, and you have to, make sure that the risk and the return is commensurate with what you're getting. Okay, so I'm taking forever here to get to this point, but if somebody says, "Yeah, I definitely want the tax exempt investment," you there's a lot of moving parts, a lot of things that you need to think about beforehand, and one of which is your tax rate. If you're in the state of Alaska where we don't have a state income tax, um, then those tax-free investments might be less attractive. If you're a high wealth individual where you're paying you're in a high tax bracket, paying a lot of federal tax, then that tax exempt might be more attractive as well. So if you're, a billionaire in California, you might want to try and pursue, tax exempt. But if you're somebody just kind of getting by in Alaska, the difference between those two, you would probably want to go with that um, taxable 10.2%. So anyway, the way you work this out is you use that 28% tax rate, and that's a given in this case. Your tax rate could be higher or lower depending on your income, your deductions, and the rest of that. And you math-wise, how you would do this is you would start with 100% and you'd minus subtract the 28%, which would leave you with 72%. So um, all you've done is just looked at of that 10.2% that you earn, you get to keep 78% of it. That's the same as expressing a 28% tax bracket, right? And so this makes it quite easy. You just multiply 0.72, that's 72%, times the 10.2%. Do that math, and obviously you're multiplying by a number less than one, so it's going to, be down around 7 point something percent. And so then you can do the comparison to the 7.9%, and you go with the one that is higher. That's the better investment. So that's why it makes a difference if that 28%, if you're in a 35% bracket or in a 10% bracket, it's going to change that equation drastically. So anyway, that's how you do that. Here's a simple one with a stock and a dividend, and the dividend again would just be added in. Now the dividend, the question on here is it per year, $50 per share. That's probably over the total term, so I should kind of clarify that. Anyway, either way you answer it, it'll be all right. Corporate bonds, we talked about that. As overall economy decrease, what will happen to the bond? So um, if the rates start to go down and you're holding a bond at a higher rate, then that would be a good thing, right? If you're holding a bond that pays 5% and the new one comes out at 4%, now you've got some value there. Now keep in mind they could call it. That's when we kind of get screwed, or other things could happen. But again, that question number three, that's not a likely scenario, and that's why I keep bad mouthing bonds, is because interest rates are quite low, so they can't really go down further. Um, Anyway, and four is just kind of a straightforward question. So those are the homework questions there. Then there's another homework back in the assignment sections, and there's a podcast. And so this gets into this notion we've talked about a little bit. In fact, I'll discuss a little bit about it tonight, but there's a concept or of picking stocks and just holding them. And this is where you're confident the entire market's going to go up versus having this really aggressive, say, mutual fund manager who's buying and selling stocks, under his management, changing that portfolio out continually, trying to market time, trying to chase gains, and doing a lot of work. And oh, by the way, he's getting paid a pretty decent salary, and he's generating, he's got employees and himself doing research, so his expenses are going to be high. The commissions on those numbers are probably not going to be free, so there's going to be some cost involved in that. And a good mutual fund manager, I mean, they're almost like a sports coach where they're paid quite well. So his expenses or her expenses are going to be reflected in the bottom line at the end of the year. That's going to come out of the fund expenses. So what this podcast focuses on is Warren Buffett, very famous guy, Berkshire Hathaway, Oracle of Omaha, real smart guy in terms of investing in stocks, and he's done very, very well for people who were fortunate enough to have money with him, versus a guy who a hedge fund guy who's going to do some of these really aggressive moves. And hedge fund is, they a lot of times they're doing short sales like I talked about last week, where you're betting that something's going to drop, and you pay for it, you buy the shares now and you pay for them later, hopefully at a lower price when the stock drops, and all this other stuff, and just aggressive techniques that are kind of beyond the scope of this. But you as a mutual fund owner who's invested in that person's fund, you're gonna stand to do quite well with their aggressive tactics, at least you would think. Now, what this thing explores is the fact that we've had a very good market, what you'd call a bull market, right? You have bulls and bears. Bullish means stocks are going up. You're in an up market, so there's it's semi easy to win. It has been. It's been going on for many years. One of the probably the longest bull market ever. But anyway, so a lot of people are making pretty good money, and just the buy and hold guys are doing quite well. In fact, actually sometimes do better than these people who are, working themselves, uphill in a lather and maybe not even achieving the same results. So that's what that podcast is about. You'll listen to it. It will, it's just kind of written in a layman's level, and so it's interesting. But I'll explain to you a little bit about what index funds are. And indexes, stock indexes, Standard Poor's 500, Dow Jones, whatever. You can pick them however you want. And what an index fund would have is it would have perhaps a dollar value of every company represented under that index, and they just buy them and hold them, and it's just completely, brain dead. They don't have to do anything. They just sit back and it doesn't take any management or any of that. They don't buy and sell stuff. They just it's so the fees are incredibly low compared to the others. So they compare the two of them. All right. And then the last thing I'm going to talk about, and we'll spend a little bit of time on this, is this term project. So again, there's no, one size fits all approach for the term project. You can do it however you want. There are some guidelines. It's not going to be a bulleted type thing. It's going to be 4 to 5 pages of, a report style term paper. I'm not a stickler for grammar and things, but again, don't just make it a PowerPoint presentation. And what you're going to do is you're going to look at your situation. Now, if you're a typical college student, and you're have just, a non-career type job, or you're not making the same money you will be making, you know, in a few years, then yeah, you'd probably take the option to sort of fast forward yourself about 5 years out to where you're established in your career, you're working full time, and you're starting to make, some, reasonable money. And it all it is just a plan for how you're going to get ahead financially in your life. So, and again, I'm saying your life and all this other stuff. Now, obviously you're not, this isn't going to mirror your own life, and you don't need to put your real data in here. But if you're going to be a school teacher, for example, you might want to pick that career field and, just come up with some bogus name, Bob or Sue or whatever, and talk about how this mythical person is going to get through their life, and hopefully they'll have, similar starting position to you in terms of career choices and lifestyle choices and the rest of it. The lifestyle part of it, if you're planning to travel the world, if you're planning to get married, if you're planning to buy a home, those things are going to impact greatly upon your financial situation. So, pick some of those situations just to sort of explore that and see where you're at. So, if you are going to have kids, yeah, college savings is important. Retirement, people live longer in retirement. And just the whole thing of how are you going to make financial details in your life fairly, make it fairly interference free, where you're not worried about money, because it takes a certain level of planning to get to a financial situation where you don't have to worry about money. Initially you have to spend a bit of time worrying about money to get things squared away to come up with your plan. But when the plan's executing, it actually should be quite painless, and you don't have to obsess about it. But if you have no planning and you're living paycheck to paycheck, well, now you are going to be, you're going to have a problem, and your life's going to be, degraded a bit. So, other things, yeah, if you've got a bunch of student loans, kind of sort that out. There are things that firms, both private and also in the government sector, that can delay, defer, even repay those things. So that might be something to think about. Social Security, a lot of folks who just ignore retirement and ignore savings, or just have other situations in their life. We've got a huge portion of the generation of the population out there who's screaming into retirement, and they think Social Security is going to be great. It's going to take care of them. Go ahead. The resources are there online. You can go to the Social Security Administration and look at your own personal details, and get an idea of what it would be like to live off Social Security alone. And I don't think you're going to like the answer. It's not certainly isn't the sunset years that you would envision. Life insurance, we talked a little bit about that. Now it's kind of time to explore and see what that's going to cost, and come up with a plan. So there are some aspects of the project that are almost checklist like. You have to kind of address Social Security, you have to address insurance, you have to address some of these things to make it a complete paper. So investing, how are you going to set that up? Probably for most of you, it's probably going to be some form of mutual funds, probably a 401k through your employer. That's all good. But just kind of look at some of the websites out there. Maybe use one of the financial planners tools that are available on those websites. Pull in a screenshot if you like, and use it to illustrate your report. Um, Real estate, obviously, you know, I've always had a strategy where, well, either way. I mean, also I've speculated in real estate, but I definitely speculate in the stock market. And sometimes when things go very well, I'll try to put it into real estate to make it more secure. But whatever works for you. Um, you can find real estate markets that are you know far scarier than the stock market. Miami Beach and Phoenix and places like that, Las Vegas, that have a reputation for. But anyway, it depends on what real estate you're investing at in those areas as well. So, pension funds and pension plans, not much of an expectation of that anymore. Even in the military, the plans have changed a bit. So, you may have had parents or relatives who had a full pension, and those are, you're kind of on your own now. You have to save up for that yourself. Sometimes you're compensated better, or it's a 401k. But anyway, the onus is upon you much more than it was before. Um, so tax deferred compensation, 401k, 403bs, thrift savings plans, that's TSP. Anyway, there's all sorts of programs depending on just about whether you're self-employed, whether you're an educator, whether you're private sector, military, whatever. Some means of tax deferred investing, and just kind of look at those. Um, Time value of money, kind of touched on that thing before. I mean, if you don't start early, or if you're mired in you know silly consumer debt where you ran up credit cards, or maybe out of necessity you ran up some student loans, and that delays your saving and your entry into perhaps buying a home. You got to work around that. So you know it is what it is, but you definitely need to start as early as possible. Um, anyway, we'll talk more about these items as we go through. But that's the project. So again, if you're somebody who's already in a career and you're just going to school part time and you're working full time, then maybe this whole 5 years thing is not necessarily. Or maybe you're an international student and maybe this doesn't necessarily apply. Well, look at how it's done in your own country. I mean, everybody has a system. Um, I've had Danish students, Chinese students, and Scandinavian students, and Norway, I guess, and Sweden. or the two students come to mind. Anyway, different systems, and just it's interesting to find out how it all works, or whether it's forecast to change too in the future. So, um, but anyway, and have had a student that I still need to take a look at the paper and resubmit it to them. But some students will kind of hit a wall, and they'll send me a rough draft and see if it's good, and that's fine too. I mean, I don't grade it. I mean, I'll wait for their final submission. But a lot of times, students will send me something, and it's like, yeah, yeah, this is good. You'll get a B if you submit this right now, but if you tweak a few things, you'll be up into the A category easily. So, if you aren't getting the grade you want on the term project, you do have some control over that, and you definitely have some time to fix it. So, okay, mutual funds. So we spent a bunch of time talking about stocks. We spent a bunch of time talking about bonds, and that's kind of because a lot of what we're going to talk about, and what most of you will be involved in, are mutual funds. And mutual funds are a collection of stocks typically. So this is one of the indices that I talked about, the Dow Jones Industrial, and it's whatever. It's the most popular. It's not the one I would definitely invest in because it's a lot of big companies and stuff. But the trajectory, the uh, rise of gain, Anyway, the appreciation, the capital gains has taken place, since 1902 up until this was about 2015. I mean, it's just continued and continued, and the percentage is unrivaled, in basically any other investing. So it's quite remarkable. You'll see, there's some dips now and then. 2007, and then, so let's say somebody was right here, and 2007, 2008 happens. We're getting killed in the stock market. Let's sell everything, and they get out right here at the bottom. The person who just sat back and did nothing, sat back and smoked a lucky, they within a year or two were just fine, and then they were still in the market and have continued to appreciate on up. So market timing would be somebody who can foresee and tell that the market's going to drop, and they would jump out right at this point. But that's pretty much impossible to figure that out. If you look at the papers today, if you looked at the papers last year or the year before, somebody's always saying that the market's going to drop, and so to figure out which one of those guys to trust is nearly impossible. So for a lot of folks, just you know buying and holding and doing like a dollar cost averaging type thing. We'll talk more about dollar cost averaging, but basically means buying the same dollar amount every month. And when prices are up, you buy fewer shares, and when prices are lower, you buy more shares. But you always buy, say, $300 or $500 worth of mutual funds every month. It tends to average out these swings, and you know enables you to enjoy the overall market appreciation without trying to market time. So here's a little bit on the background of mutual funds. So mutual funds, it's funny, mutual funds, there are more mutual funds out there than there are underlying companies, because there's mutual funds can be, you could get any combination of stocks and put them under a fund, and you've got a mutual fund. Now, just about all the mutual funds are made from stocks. You can also make them from bonds as well, which we know about bonds. And they're managed by a portfolio manager who decides, securities to purchase and all the rest of that. So that's what I was talking about. That would be the fund manager, and if he's or she is very good, yeah, they're gonna, be fairly famous and get a premium salary, and have fairly big expenses that are fine. I mean, if the mutual fund is screaming up, and they're making all the right choices, They deserve that money, and you'll gladly pay it because you're making all kinds of money from their decisions. But if they're, conversely getting paid quite well and making poor decisions, then those are not the people you want. So why do you want to do mutual funds? Primarily, it can all be summed up as is they're easy and they're diversified. So you could, how do you start buying a mutual fund? Let's say your company is not associated with anything and you just want to start buying mutual funds on your own, or you want to buy more. It's easy. You pick any one of those companies and they'll probably have, sometimes maybe a $2,500 minimum amount to set up an account, unless you start with a monthly investment, directly debited out of your account, in which case they'll probably do it for like 25 bucks. So it can be quite modest, and you just start small, and as you can afford more, then you can just update that and increase that amount. So it's just very easy to deal with these folks. Very user friendly. The websites are nice and functional and flashy and easy to navigate. Everything's denominated in dollars. You don't have to, you have to do a little bit of research initially to figure out what mutual fund it is you want to buy. But once you're in there, it's the portfolios manager's job to, make the decisions, the buy and sell decisions, and the rest of that. So that's kind of neat. And then also the diversification. Rather than buying an individual stock, you buy a whole bunch, across the board. And so if a single company, um, were to go under, the competition, which you probably also own, would take up the slack. So the way they do mutual funds, because an individual stock is very easy to price. You can buy and sell throughout the day. With mutual funds, when you've got a whole bunch of different shares and different amounts under a fund, it would be difficult to calculate the value. I mean, obviously, it could be done quite easily with a computer, but anyway, just out of tradition, they don't do that. They just once a day will determine the net asset value, and so they'll put that out, and then you'll see it expressed as a share price. But again, when you're buying mutual funds, you don't have to buy a certain number of shares. You typically buy them in dollar amounts. So, you buy $100, $300, whatever amount you want. And the number of shares is just kind of transparent to you. Open versus closed end funds. Yeah, there sometimes funds like some of the Warren Buffett funds, like the Berkshire Hathaways, you couldn't necessarily jump into those. And different funds, they use these terms in different ways, but one way of using it is um, you know have to deal with, or deals with funds that are open and to new investors and some that are not. What would happen is if you have a mutual fund company that's doing quite well, and all of a sudden money starts flocking to it, and let's say this mutual fund wants to invest in small startups. Well, they're like an elephant in the room. They every time they invest in a small startup, they just distort things just by virtue of their size. So you'll see some mutual funds um, be closed to new investors because the portfolio manager has decided that for to reach the goals and to have the agility that they want within that fund, they can't be that large, and they just don't want new investors. Um, so net asset value and discounts, things like this. There's a number of places to buy mutual funds, but typically, let's say you go to Fidelity. If you've got a account with Fidelity, you can typically buy pretty much any product that's on the market. They have their own branded um, accounts, but they can also sell some of their competitors' stuff. So some of these things with the discounts and the rest of it is you're when you're buying mutual funds, you're not dealing with stockbrokers. You're not dealing with commission salesmen typically. you want what they call no load funds, which are funds that have, no sales load attached. There are some loaded funds out there, but they're a very, very small percentage because they're very unattractive. And why pay a commission when you don't need it? There's not a lot of value added to the commission salespeople in mutual funds. And this is what they're talking about: load versus, and those loads too, because commissions are typically charged up front. Um, yeah, it kills you because that is the time value of money. And if they take their commission up front, let's say you're only investing $100 a month, but their commission eats up most of it. Man, 30 years from now, that $100 would have been worth a ton of money. You actually see some backside commissions on some companies where they charge a commission, but it's not till when you sell the shares. That's fine. I mean, if you're gonna pay a commission, because at least now they've got some skin in the game. The more money you make, the higher their commission is, and the commission comes off the back end, which is experience the time value of money and didn't cost you. So um, here's an example of loaded versus unloaded. Big picture is there's no need to buy a loaded fund. Expense ratio. So 1.5% they're saying is the average. But many times, if it's a um, index fund, for example, those fees will be incredibly low. And so again, without that 1.5% annual rate, that's going to get expensive. Um, Funds with lower expense ratios, especially when things are going up. When there's a bullish market, and everybody's basically winning. Yeah, the ones with the less expenses are going to do better. But that's a bit of a generalization. And if you've got a fund manager who's outperforming it and outperforming it by the amount of his expense ratio, then even if his expense ratio is 3 or 4%, if he's getting yields 10% higher than the market, well then that's money well spent. So you have to look at it. So different mutual funds. So mutual funds will be categorized on, well, they can be categorized in a million different ways, but we're going to look at some of the broad groups. Growth funds. Typically for folks who are young, or people like me that are still, maybe not so young, but still very aggressive, uh, be drawn to growth funds. These are companies that are, intent on growing, so they're not paying a dividend. They're not an income, stock. The money you're going to make is by the share price going from, $10 to $20 to $30. You get a big bellwether, big blue chip company that's paying a dividend. They're not going to have that kind of growth rate. There's just nowhere for them to go typically in those sectors, so they pay a dividend. So, but anyway, growth funds are kind of the opposite of that. And capital appreciation funds. So again, just a little higher. So a lot of these terms though are just strict marketing. So you can come up with rapid growth or whatever growth. These are just categories, and you'll see some terminology kind of float in. You have to look at the underlying stocks. Then also stocks can be split up. Now, growth funds would typically be small cap, right? Small capitalization, meaning they're relatively small and they're starting to grow. Mid caps are, again, it doesn't tell you exactly whether they're a growth company or not, but it just tells you that they're a medium sized uh, firm. And then equity income funds. This is what I was talking about, where you talk about typically a very large capitalization where they're um, have a big behemoth company, and it's unreasonable to expect them to grow quickly. They've already been through that phase, and now they're attracting investors and taking care of the stockholders by paying a dividend. balanced growth, so income funds. So, different hybrid type things. Sector funds can be sectors, can be anything you want. I mean, they can be geographically diverse, but what they're talking about here is sectors in terms of like technology or biotech or defense or whatever type of system. And you can split them up even further. You can, within biotech, you can get into medical hardware. You can get into pharmaceuticals. You can it's That's why there are so many funds. But um, you if you have an inkling that a certain sector is going to do quite well, but you don't know the specific company, then that sector fund might work well for you. Um, so index stock funds, what they're going to do there is they're just going to grab something like the Standard and Poor's 500 or some other um, index that's out there, and the fund manager, well, he's not much of a fund manager because he's fixing to be unemployed here. All he's going to do is just buy a certain number of shares um, within that entire index and just buy and hold them and not sell, not try to do any market timing. And since he's not doing anything other than that initial move, the expenses are going to be very, very low. And so when the market, as it has been in the you know recent history, is going up in a bullish trend, you can do quite well, and just because the expenses are so low. And so that's what the focus of that podcast will be on. International stock funds. So two things here, subtle difference: international and global stock funds, right? And this would be, let's say you think, a country is, Brazil or Vietnam or something in India you think is going to do quite well. You want to invest. You can't go to their stock exchange. It probably would not be legal, but then also it would be impossible from a tax perspective and from a currency exchange perspective and just everything else. So you have an alternative though. You can um, look for any one of these mutual fund companies will have international funds, and you can invest in that manner. And so you can get the investment you're looking for easily. So it could be an international stock fund that's got a number of countries in it, um, or it could even be a global stock fund, which is slightly different than an international stock fund. A global stock fund means that it can have investments outside of the U.S. and within the U.S. By definition, an international stock fund, if that's how they're calling themselves, by the rules, they would have to have stocks that are all exterior to the U.S. So not a huge difference. Socially responsible stock funds, you can find companies that, don't invest in this country or that country, or don't invest in defense or whatever. Um, and anyway, those things are available because there's a market for them. So again, you have to do your due diligence to find out, whether these companies are legit, and also whether they're actually, making money for you. But if they can do that, that might be something you're drawn to. Other types of stock funds, yeah, there can be all sorts of blends. Exchange traded funds. This, when you have the big mutual fund companies, it kind of puts the traditional stock market, stock brokers and you know brokerage industry, kind of puts them on the sidelines. So in order to get back in the game, they've come up with these exchange traded funds, and they trade them like stocks, and you can trade them throughout the day and the rest of that. Um, but for most of us, it's mutual fund investments are more of a long-term investment. Even when I say I invest, speculatively in the stock market, still the preponderance of any money I have is in these big, large mutual funds that are associated with the companies I've worked for. and you'll probably be in the same boat. Um, you could go to any one of the mutual fund companies and take a look, but Vanguard's a big one. That would be one place to start. Vanguard, Fidelity, T. Rowe Price, different companies. Easy to find. Um, Bond mutual funds. So we talked about most of these were equities that would be under the Vanguard. Vanguard may also have some bonds, but we were talking about company ownership. When we say that there's bond mutual funds, they can be comprised of, T bonds, treasury bonds, and some of these mortgage bonds, even corporate bonds. I've never been a part of, well, I guess I've done short-term bonds, short-term bond funds, but that was a different time, and we were getting pretty good interest rates then. Bond funds, this is what sort of happened in 2007, 2008, where they had these collateralized debt obligations and all these other, names. What they did was they got a bunch of junk bonds and they put them together and they said because they've been combined together, that you've got some diversity there and they're more secure because they're based upon mortgages. And anyway, it was a sham. You know a, all you had was a bigger pile of junk, and the mortgages weren't the true mortgages. That you didn't necessarily have families living in these homes. You had speculators with 6 or 8 mortgages, so there wasn't much security to them. So um, you have to be careful, again, um, looking at what's available. Mutual bond funds, municipal bond funds, um, that might be one way to do it too, especially since municipalities, um, the days of those folks not declaring bankruptcy and taking your money with them are gone. So if you're going to go into munis, that might be one way to do it. And then index bond funds. So other ways to do that, international bonds um, can be even riskier. A lot of times the regulations in some of those other nations, and again, it depends where you're going. But you have to. It is tougher to look at some of those foreign bonds, especially if it's in, um, you know, some of the non-first world countries. Um, Return from a mutual fund. So just like if there's underlying stocks that are paying dividends, you would get that dividend, and then also you would get them um, when you buy and sell the shares. But also if they're doing some trading within the fund, you might also get some capital gains that way. So it's all very clear cut though, and at the end of the year, you get a statement that shows the income that you've generated that year, and typically you can use your fund to pay those liabilities. So if you've got a fund like that, if it's a tax deferred one, a 401k or something like that, then that's not going to generate a taxable event. But if it's when you just have cash with extra savings, then yeah, you're going to have to pay that amount. But you could quite easily do that by converting, redeeming some of those shares and paying the tax bill. Um, so short-term capital gains, long-term total income, and then they're showing the different load and what their tax is going to be. These are just generic numbers, so not a very useful example, but just the same. Stock mutual fund, it's the same as the stocks, although just a little bit less risky because you're not invested in a single company. But anyway, conservative stock fund, certainly, yeah, limited return, limited risk. So risk and reward are typically related. And high return, high risk. I mean, that's the way it should be with pretty much anything. With a bond fund, obviously you can have the default. So if the municipality or the corporation who has the bond If they fail to make the payments and they go into default status, then you're at risk. So um, here's where they're saying, risk versus return. Index fund, it depends on what's under that index. There's technology indexes that can be pretty aggressive. Income fund, typically, yeah. Capital appreciation, global because of the exposure. Um, Foreign growth stock, one small country. Depends where that country is and what their track record is, but um, it's again, you have to dig down into these different funds. Um, just to say growth stock fund, there are some within that sector that are quite risky and some that are fairly benign. So you have to do a little more research. And global stock funds, just because it's global stock fund doesn't mean that it has, equal exposure in, Africa as it does in Scandinavia. I mean, you may have a global stock fund that's exclusively investing in Scandinavia, which would probably be quite low risk, whereas one that's, in emerging countries, that could be quite risky indeed. Bonds, same thing. Typically with bonds, the shorter the exposure, the lower the risk because interest rates are not going to change that quickly. If you're trying to predict interest rates way into the future um, and trying to get a very high yield, yeah, that's going to be very, very high for risk of default and should be the interest rate should be up there as well. So just what I said, long-term bonds are most sensitive. Yep. So junk bonds, this is, very speculative. And the reason why they're rated junk is because, the independent bond rating agencies have decided that there is a very high, you know, chance of default. So shorter term and longer term. And again, less diversified, focused on one country, whereas something that might be more spread out. Selecting mutual funds. So you have to be forward looking. It's very easy to pick up like a money magazine and see what the top mutual funds were for last year, but you have to look at a proven performance over time and also some of the factors. What's happened during those 5 years, what caused their growth. There's always going to be a thing called a prospectus in a mutual fund, and that's sort of the rules that they have to play by. And so it will tell the objectives of the manager, but it also puts some limits on what kind of trades they can make. So the fund prospectus is definitely something that legally you have to read. You have to at least knowledge, you read, but unlike some computer, terms and conditions, you really do want to read that prospectus to figure out whether it's in line with what you're trying to get involved in. Investment strategy, performance, and again, looking at the long term, or you're trying to forecast in the future. So past performance isn't always indicative, but um, some people have a knack of repeating returns over and over. Expenses, back end load was where they take a commission off the end. The management fees, and then how to redeem the shares, the minimum balances. Like I said, they're typically quite low if you're going to set up for regular investments. And so we talked about Vanguard. Now we're looking at Fidelity, and there'll be a mutual fund selector in there to help you. Quotations, again, use the charts. They're available on any of those sites. So this tabular data is of little use. I mean, it is interesting, but a chart is much more useful. Um, this is actually from the Mutual Fund Education Association, so they've got some information in there. All the companies contribute to it, so it's a little bit broader. Diversity, I've done this before where I thought I had diversity amongst mutual funds because I had them with a bunch of different companies. But I look at their underlying assets and it's all Amazon, it's all Apple, it's all, they're all good companies, but I'm fooling myself by thinking that I have different brands of mutual funds when the underlying assets they have are all the same companies. Um, and typically a lot of them do tend to go up and down together. So, but the thing is making sure that you've got the appetite for the risk. That when the market goes down, that you don't panic. That you hopefully stick with it and come out on the other side. So a little bit on diversification. Different countries, but the problem with this is the U.S. is still pretty dominant. And if the U.S. gets a cold, the rest of the world sneezes, or however you want to phrase that. But you very rarely see where the U.S. market um, goes up or down and doesn't take the other nations with it. So it's not always a perfect hedge. Speaking of hedges, hedge funds, and again, this is very high paid folks who jump in and out. They make very strategic moves. But it can't be for everybody because you can't be a contrarian if the whole pack is doing it at the same time. So these are very personality based, very the hedge fund managers sometimes do quite well, which you hear about, but you don't often hear about them doing that poorly because they tend to keep that a secret. So um, you have to look at that. The Madoff scandal, Bernie Madoff. Investors should have been suspicious when they were getting those sorts of returns year after year and doing it in what they were told was a risk-free environment in the homework. So one thing I want to do is I'll show you just a little bit um, on the Fidelity site. So you can go through here. I have an account with these folks. I'm not going to sign in, but it especially for doing your term paper, um, you can come through here and look at the retirement sections. If you want to look at mutual funds, you can get an idea of what they have. They're going to try and push their own stuff, but they'll look at other companies that are out there. Morningstar is a very good company, third party that rates funds. So you can look at their ratings and go figure they're going to have the Fidelity ones up there at front. But here's Berkshire, so that's as I talked about Warren Buffett, BlackRock. These are some of the competitors. Morgan Stanley. So any of these companies, and you would go through and you'd look at the yields and again, it's all this stuff is very interactive. You can look at the rankings, the fees, the risk. It's quite easy and it's overwhelming the number that are out here. We've got almost 1,200 funds. So you could, we talked about socially responsible. We talked about closed end. You can narrow your sector down. You can look at fund families. Those are the different companies out there. Fund types. We talked about just a few, but you can see, sector equity, taxable bond, U.S. equity. I mean, there's so many options. So explore those sites. Anyway, I think that'll wrap it up for tonight. But we left off where we started, where you're back at the homeworks and working on the project. And good luck with that.